Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 U.S. market update. In my last recording, we decided to forego the normal injection of humor and just said, hey, listen up, things are about to get serious, and they have. And unfortunately, with today's market move, things aren't any less serious. Let's take a look at the charts and I'll show you what I mean. As we take a look at the chart of the S&P, it was another ugly day, I'm sure you already know, in the market, but something significant did happen, and let me show you what I mean. We use this really cool new zigzag tool we have here. You watch me do these recordings, you know I used to have to do all this by hand, but now it's all drawn out for us, and here's the move to the downside today. And you can see that we have a potential C-wave extension at the 161.8% fib level. Last night, we did a recording on the Trade Finder Live, did a webinar, I should say, on Trade Finder Live. We were down here and had bounced off the 138.2% fib level and said that if that didn't hold, then we were going to come down to the 161.8% level. And we did, and that's been our Katie bar the door level that we've talked about in previous updates. Today, the big news throughout the financial markets was a well-known fund manager came out and basically said that if the president didn't shut the country down, just shut everything down for 30 days, hell was coming. And that got a lot of attention. He had tweeted it out and was interviewed on the financial networks and basically said that he felt like everything needed to be shut down, not just select restaurants, etc. We take a look at the 161.8% fib extension with a 50% correction. You can see we went up to just right at that 50% bounce on the B-wave correction. 161.8 is already an extended level. 100% is what you would expect with a 50% correction. So anything after that becomes an extended C wave. 161.8% is a primary level, and we need to hope that that holds, because if we don't, then this is the next level. And this will not be any fun. Not that anything that we've experienced up till now has been fun. We actually had a decent day today for our subscribers. That's one thing that this volatility allows. We had a put on the S&P that we closed out for just under 100% gain in a one-day trade, and a call spread that is up about 15%, all occurring in the same day. Downside trade and an upside trade, both making money in the same day. But it's tricky, and things move extraordinarily fast when you have a VIX where we have right now. And take a look at the chart of the VIX. This is fascinating that we've been up at this level for this long. If we go back and look historically, you'll see that usually when we get spikes, we get a pretty quick downward move. Here's a spike that occurred back in February 2018. You can see up to about 50, right back down. And that's what usually happens. You get an elevated move, but it's short-lived. Here's one that occurred back in 2015. Spike up above 50, right back down. Little small ones along the way where we had a little bit of extra volatility. And you probably can guess where I'm headed to. I'm going back to there. There's some right there that bounced up and then back to the downside back in 2010. But I'm heading to 2008. And here's where we were back in October 2008. That's the only thing that comes even close. And even with that, we had some bouncing back and forth, some up and down days. We had quite a few days up in this level, but with some retracement days. And we just haven't had that many of those. With this move, just a couple upside days that have been sprinkled in. So the fact that we have stayed up here could give some positive feelings of the fact that we can't keep this up for too long, staying up this high. But here's where it gets scary. We put the Elliott wave pattern on there. It shows that we're in a wave 3. So we should get some sort of a move back down, some sort of a reprieve, maybe with the passage of the stimulus bill that's expected. Pieces of it occurred, some a little bit today, some tomorrow, but the big ones on Friday. That's when the vote is supposed to occur. Maybe that gives the market a little bit of pause here, rests a little bit. It seems as though the market doesn't believe the stimulus package is going to happen until it's actually passed. That's the way the market's acting. But the fact that this is just a wave 3 and then we could have a corrective move and then continue even higher or back up just above this level again, that's pretty scary. But that would actually play into a potential move here. Now, what normally happens when you have an extended C wave is that you bounce to the previous fib level. Quite often would like to see a bounce all the way back to this 100% level before you would consider moving down to a new extension level. But lately, the 138.2% level has been working as just a test, so we haven't had to go all the way back to a more premium level of 100%. In this case, the 100% extension, I'm saying calling that a premium level because that was the expectation of the C wave to the downside, and now we're in the extended part of that move. So we'll see how that all plays out. We put the Elliott Wave pattern on and note that we're in a wave 3 here, and so there's your clear zigzag out of this move, and that's why I like to trade these corrective patterns of flat zigzags and triangles, because you can make these trades within the wave 3. You don't have to wait for the 1, 2, 3, 4 all to occur and just trade the end at the 5 wave. But I did want to share that stuff with the VIX. Taking a look at the interest rates, TBT. We did bounce back up here as we should in the Elliott Wave pattern to a corrective move, and this actually should have been a bit more positive for the market. That interest rates have moved back up a little bit, because with lower interest rates, banks can't make any money. It's very difficult for anything financially related to make money and survive. And it's going to be difficult for some of the smaller banks, I think, to survive what's occurring right now. And you're going to see some bankruptcies, and the government can't bail out everybody, even with this big stimulus package. And I think the market, part of the reason that we're having so much damage to the market is even with the Fed throwing the kitchen sink at it from a financial standpoint, a liquidity standpoint, to keep the financial markets moving, the treasury markets moving and liquid, going down to zero. It's like entitlement programs. Once you give something, it's almost impossible to take it away. So they keep saying, oh yeah, well, when things calm down, the Federal Reserve can go back to raising rates again. Well, that didn't work so well last time they tried to raise rates, did it? So obviously we'll have to get off zero at some point, but how far down the road is that? Other countries are still at negative rates. So that's going to create some further damage down the road as well, in addition to what's occurring right now. And I think the market is discounting that in addition to what's going on with the coronavirus, etc. But this just looks like a wave 4 bounce too, and then rates are going to come back down, and that's not a good sign for the economy, because at this point in time, the Federal Reserve can't cut anything more unless they go to negative rates, which they said they're not going to, and interest rates are going to inch back down as money moves into the bond market because it's going to be fleeing other things. Last but not least, looking at the dollar, and this big spike up here is not good. So you could make a case to where this should be helpful, but it hasn't been to the market. This is not helpful. It does make sense, as I mentioned in the Trade Finder webinar last night, the fact that money from around the globe is moving into the dollar has always been viewed as the safe haven security. And so that's a currency, and that's what's been occurring. But it's not helpful to multinational companies, but it's not a whole heck of a lot of business being done right now anyway, is there? So things are pretty serious. I just wanted to share this with you. Let's hope that this gives us some sort of support. We get a little bit of a bounce back up. Last but not least, I'll put the moving averages on there, and you can see that it kind of would make sense. Not a whole lot making sense in this market, but a bounce back up to that 100% level would be around where the 10-day moving average would be coming down over the next several days, or a few days at least, and the two could meet right there at that 100% level. So that would actually make sense. We'll see if it plays out that way, but it's pretty ugly out there, and unfortunately, it could get even uglier. Take care, and I mean that sincerely. Please take care and be safe. And we'll talk to you soon. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.